Good morning, everyone. Welcome to our webcast on trading a smaller account. I'm here for Barb Armstrong. She said she's going to visit family, but I really think she's got her eye on a cute new little grandson that I think has stolen her heart that she's visiting with today. So I'm happy to step in, moving over from the chat. Now, how many of you have a process that you like to follow? When you're trying to trade and you're getting things set up, what are the things you like to do? Do you have a checklist? Do you go through that methodically? Well, I'm going to suggest to you today that having a process to follow can save you some time. We all know our time is valuable. It would be nice to be efficient with our time. So we're going to talk about that a little bit here today. Now, I am joined in the chat by good friend Ben Watson, fellow coach. You guys know Ben. He's here to help answer questions maybe that I can't quite get to. He'll have my back there. But as you have questions, go ahead and chat them in. I'll keep an eye out for questions. Ben will be looking there as well. Now, those of you that are listening to this on the archive, when you have questions, put them in the comments section of YouTube. And we go back every day and look at your questions, try to get them answered really quickly for you as well. Now, I do hope you're following us on X. It's free, it's easy. I'm Connie Hill CS. Ben is Ben Watson CS, and we'll post educational content throughout the trading day, little nuggets that we may have run into. Let's go ahead with our disclosures here, and we'll get into our agenda. We've got a lot of ground to cover here today. Options carry a high level of risk and are not suitable for all investors. What we talk about should be considered informational and educational. Don't consider it a recommendation. We will be using the downloaded Paper Money software application. It's for educational purposes. I think it's a fantastic tool as you are learning new strategies. Investing involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. Now, I just want to give a little push out here to some upcoming workshops. So we're going to have Detroit, Denver, Anaheim. Mr. Ben Watson, who's out in the chat, will be there for each of those events, leading those discussions. And he does a fantastic job. It's free. We're nice to you. We even feed you, okay? Where was this when I was learning how to trade? Oh, it would have been awesome, okay? So take advantage of that opportunity. Now, typically what we're going to want to do, and something that we're going to build in as part of our process that we're going to talk about today, is a market overview. Are we more bullish? Are we more bearish? What do the markets look like? We always want to do new trading examples. I've got several lined up that I'd like to show you here today. And because I was here last week, we are going to look at some of the trades we put on last week and just see how they're faring, see if there's some things that we can learn from them as well. Now, I'm going to go back and look and see how many of you say you do have a routine. Now, I think Paul said you've got one. Great. Maybe not everyone has a process yet, but by the time we're finished here today, I want you to understand how important it can be. So let's first go and check our markets, and that really is going to be step one in your process, is to evaluate where is the market right now. Typically, we'll use the SPX and the NDX to use as a gauge. And we can see here on the SPX, this is just a 6-month chart. And geez, what is happening today? You know, we had this down drop here, which was a flagpole, and we had a consolidating flag in here over the last couple of weeks. And what is it doing today? Boom, it is breaking out of that flag pattern. That can be a new entry on bearish positions, assuming, you know, you have some positions that, or some stocks in your watch list that kind of are looking similar. And when we see flag patterns in indexes like we're seeing on the SPX, there's a tendency to see a lot of them out in the markets as well. Okay, so individual stocks might exhibit that pattern as well. My blue line is a 10-day moving average, so we can see, boom, yeah, really dropped below that today. And then the 30 is the red one up there. That's a little bit on the short time end of an intermediate trend. And so, yeah, both of them are headed down. Now at the bottom, we'll just consult with this occasionally. I have an ADX. ADX stands for average directional movement, and it gives us an idea, what is the strength of the trend? Doesn't matter the direction, okay? If it's 25 or higher, it's letting us know that trend is pretty good, pretty strong. If it's lower than, say, 25, maybe it's in the 20s or the teens, then the trend strength might be weaker. So we'll look for something, say, above 25. We can consult with that. And on the market overall, what's interesting here, right now it's at 30. So it is still above 25. It doesn't matter what direction it's going. The fact that it's going down just gives us an idea that the trend right now is not as strong as it was back here when it was going up and peaking. Okay, but still pretty strong. Let's look at the NASDAQ. I have a feeling that it still is looking similar to what we were seeing on the SPX. Big, giant, long flagpole, if you will. If we looked at this as a weekly chart, we'd see that a little bit cleaner. But same type of thing. We're in this consolidating ranges of a flag, and it's been there for a couple of weeks plus, right? And so even though it had gone above the 200-day moving average, and that was something that was positive and bullish, what we're seeing right now, breaking out of that flag pattern, forming a lower low, definitely is a lot more bearish than bullish. Okay, so step one is analyze your posture. All right, Wiley is part of his process. He prays every morning. Great wisdom, Wiley. Yeah, thank you for sharing that. Appreciate that. All right, so let's take a quick look at our couple of trades we did last week, and I want to spend the majority of our time putting in some brand new trades with some different objectives than maybe what you might be used to. Now, I need to kind of close up some areas here. These are the 3 trades we got into last week. Nike, we were able to get out of this morning. All right, if we come over to Nike here, we had done, let's see here, on Nike, we had done, let's see what this is. Those are calls, okay? We had done a long call spread, or a long put spread, no, a short call spread rather, okay? And on the account statement, we can see we brought in 26 cents as a credit, and we were able to buy it back this morning for 4 cents. So a net of 22 bucks per spread. We had 6 contracts. That gave us a little credit, kind of a base hit trade. And we can see here, it was a 70.71. We just needed it to stay below or go below this area here that I drew in, which is the 71 area. And sure enough, we got in here and then it just dropped today, making a decent sized move that allowed us to take our profits and get out. And I'm going to say the majority of the profits. We're not going to hold out for every last little penny. Sometimes that's not the best way to approach spread trading. Now let's take a look at Starbucks. On Starbucks, we were doing something a little bit more directional with it because we did a long put vertical. It's also called a, some people might just call it a put debit spread. Okay. Some people might call it a bear put. There's lots of names for the very same strategy. Sometimes that can be confusing when you're learning the strategies. I'm just going to refer to it in this class as a long put vertical. We know that it's going to be a debit spread. In any case, Starbucks had been in its own little flag pattern. And when we got in last week, it was because it broke down outside of the flag. And then as far as trading flag patterns, if the price goes back into the flag, that's a reason to say, whoop, it's not following through the way we thought it was going to follow through. It's not doing it. We need to get out of the trade. Now, what we saw here, it was still kind of drifting out here despite the fact that we had a couple of candles. However, if we had a strong close, say above this 99 area, which then would blend into the flag area there, if the lines were extended, that would have been a reason to get out. Yesterday, it just started to dwindle a little bit, and then today it's down a little bit more. We need this thing to drop a little bit more here. We've got a line here at 95. Our target is for the stock to go below 95. We still have about 3 weeks left on this trade. April 17th is its options expiration date. And all right, there's Nike, there's Starbucks, Qualcomm. Now we're up a little bit in Qualcomm. We did a short call vertical here as well. We brought in a credit of about 181. The spread value right now is about $1.11. So it's eroding, it's evaporating, which is exactly what we want to have happen on a short call vertical, short credit spread using calls. Okay, I'll use ultramanology, so you know what it is. Let's just take a quick look at the chart because we're just going to keep letting it work. We've got 20 days left here still. So as we pull up QCOM, let's just take a quick look at what's going on. It had been downward trending. It had met kind of like a little triple top up here, and then it's kind of been consolidating in this range. When we looked at it last week, it looked like it has maybe bouncing down off that 160 resistance. Looked like at the time we got in that it was breaking down below the 10-day. Now here, I think a lesson to be learned is even though the stock may go the opposite direction of what you want it to do, we need it to fall, it doesn't mean the trade is just all horrible on you and you need to panic and get out if it goes up near your short strike. Even though it may go up there and there's a high probability it will, it doesn't mean that it's going to expire there. Okay, so it was up above here for a couple days, and sure enough, weakness moved back into the market, kind of wiped out those little gains that it had as far as being bullish. They weren't gains on our trade. We were actually down, but of course, with today's price action, it's looking better. So we're just going to let them work. And that's one of the things with credit spreads as part of the process is after you get the trade on, try not to meddle with it. Try not to fiddle around and ruin it. Just be patient and allow it to work. All right. Hopefully that makes sense to all of you. So as part of our process, we analyze what the market's doing. Step 2 is we're going through a watch list. Now, what I told you last week is that the day before, on March 20th, I had built a watch list with my short verticals class. And on that watch list, we built something that would have possibly some bullish opportunities on it and bearish opportunities. And we're just going to stick with this watch list for a while. We may have to go refresh it. But this same watch list can be really helpful for any type of strategy option strategy you might be trying to learn or trade. Okay, so it's entirely appropriate to use this kind of a criteria for this class. So just briefly, and I'll put a link into the short verticals class that I taught last week where I showed you how to actually build that watch list. And it was a little bit detailed to bring those two together. Mainly it's S&P 500 stocks, S&P 100 stocks, I take that back, NASDAQ 100 stocks, but they have to be stocks that have a lot of trading activity on them. I think we have 2 million as our minimum on the volume, because that will lead us to more flexibility with options, right? Having a more open interest, and that is such a key component. So step 2 is going to be going through your watch list and seeing what has a technical setup for you, okay? Not all charts are going to have what you're looking for at that time. One of the beauties of having a process that saves you time, we're not going to go scrambling out and looking all over the place to find something to trade. Our watch list is something we've said, yep, we're willing to trade this if we see the right signals on it. So step 2 is just kind of going through that list and seeing what appears to be there. So first trade that we're going to do here, we're going to look at Amazon. Now Amazon, it had been trending really nicely till it hit its peak here recently. And then with the sell-off of everything, it's been pulling back. The thing that's intriguing here about Amazon at this moment is that today it's trading below that 10-day moving average. And notice how that 10-day moving average seems to have been acting as resistance for this stock for a while. Yeah, it broke through, ran up to the 30, but it's just rolled over again. So we're going to use that break through that moving average as our entry point here. Now, something more conservative that we could consider doing here would be a short call vertical, right? A credit spread. And let me show you the strikes I had in mind here. We're going to go with the April 17 contracts on this one. We're bearish, so we're going to go on the call side of things, and then we're going to search this delta column for a strike price in a delta that we're comfortable with. Many traders like a 20-something delta to maybe a low 40-something delta. Some like that sweet spot of about a 30, 35-ish delta, okay? We don't always have the exact one that we want. It's nice if we do. It's not always the case. But looking here, I'm looking at doing, look at all this open interest and volume activity. we love to see that. Okay, we love to see, no matter what strike price you decide to go with, there's lots of contracts out there. So it doesn't create a liquidity problem for you. Okay, let's go with, let's see if this still works out. This is what I had in mind initially, and we'll see if selling this vertical with these strike prices gives us a return that's worth our while, a return that we can be comfortable with and proceed. I'm going to put that back to 68 cents because it was just there. All right, max credit on this trade would be $68 per set of contracts. Now, one thing that I should have done before we did any trade here is the parameters of our class. So I'm going to go back to the slides for just a minute here, okay? Because in this class, it's a $20,000 paper money account. Barb started it over at the beginning of the year. The most we can put into a position, a single position, is about $5,000. And normally that might be with a stock purchase, okay, as opposed to an option purpose. But we don't want to risk more than $400 to $500 on any trade. Okay, so we're going to position size to that size of the account. We're looking at short to intermediate time frames. We're looking at both bullish and bearish opportunities. And then these are typically the bullish opportunities we might take a look at. We might not cover too many of those today. But the bearish strategies would be long puts, long put verticals, and short call verticals, which is what we're looking at right now. Sometimes we'll do iron condors in this class or calendars, which can be a little bit more on the neutral side of things. But these are going to be like our bread and butter strategies. Okay, what we're seeing right here when we're in bearish markets. All right, I needed to establish those parameters. We may have new people. We have new people joining us all the time. I want you to know what rules we're following so that you can follow along with us. All right, back to our trade. If we have about 68 cents to gain, let's do something here. Let's bring out our calculator. And let's figure out what the return might be. I'm going to open up our scratch pad here because I'll probably be making a few little notes in here. And maybe I'll put some notes just under where I have some of these scripts located. All right. So 250 is our spread. So we're going to say 250 minus our credit of 68 cents gives us $1.82. That's our max theoretical loss. So we're going to risk 68 bucks. All right, I take it back. We're going to risk $1.82 to try to gain 68. Now you're like, oh, well, we're risking more than what we're making. Why would we do that? The reason we would do that is because it's a high probability trade. You can see right here, the 202.50 right now has a 74% chance of expiring out of the money. Fabulous. We like that, right? We want it to expire out of the money. So from the get-go, it's in a pretty decent situation. Now let's check the reward here. So we'll take our 68 cents, divide that by $1.82. That's about a 37%. Now some people might be happy with that, especially combining it with the idea that we're just planning to be in the trade less than 20 days, right? We'd want to get out typically before it actually expires. And so yeah, that might meet some people's rules. Some people might say, well, I'm going to go a little further out of the money. Maybe I want to sell a 205 and see if I get enough return there. I'm comfortable with the return that we're going to generate here on this one at that 37%. So we're going to proceed. Now, if we can only lose in this account, and it's not that we want to lose this, but we've got to be willing to risk in order to trade. Okay. What we need to do, we'll take our 500, we're going to divide that by $182 to find out how many contracts we can do. We can do 2. Typically, you want to round down, don't round up. Even though it's tempting to run up because that puts us beyond our risk level that we're comfortable with. So we don't want to do that. So we're going to do a couple of contracts here. I'm going to change that to a first trigger sequential. And we're going to put in an exit order. And the exit order is going to be, if we get enough of this, if we get a big enough chunk of this credit, we want to get out. We're going to be happy to exit. We're not going to try to pick all the little breadcrumbs up. We are just going to have the main part. And somebody, I think it might have even been in this class last week, somebody said, well, it's like maybe having a sandwich and cutting the crust off the bread, right? You're getting a little rid of a little of it, but the main part of it is still there. So let's create an opposite order. And when we get a chunk of this, and let's go for today, let's go for 70%. You get to decide what that percent is, and it might be different per trade, okay? When we get 70%, that means only 30% is left. So we'll take 30.3 times 0.68. That says go buy it back at 20 cents. Okay, we're going to put it in. We're going to be happy. The 20 cents are the breadcrumbs. All right. And not 20 bucks. That might be a little tricky here. Let's go back. 20 cents. Those are the breadcrumbs. And the meat is basically going to be about 48 cents worth. Okay. Is it a big trade? No. You know, knowing that we're kind of looking to get maybe around 48 cents on a couple of contracts, you know, it's around $100, not including commissions. It's a little bit less than that, but it's just one of those base hits, and those base hits add up over time. Okay. So we did our posture. We did a technical analysis of the trade. We looked to see if it gave us a good enough return, which it did. So we're going to proceed with it. And we're going to let this stock, with this little trade, we're going to put it in our trading a smaller account bucket. We'll be able to follow up on that in the future. All right. Let's see here. I was just looking at what Tommy says. Today is the worst. Today is worst a bear on Intel. Must be something that you're trading, must be getting hit pretty hard. A lot of semiconductor stocks are getting hit pretty hard. All right. Next one up. Let's take a look at this chart. We're going to do something a little bit different with this one. And see, HP is still following our process, right? We're going to look at bearish stocks, bearish trending stocks from that watch list. Now, I'm going to collapse the calculator for a minute because I know some of you like to take a look at the watch list, see what we have on it. I'm going to keep it at the bottom end of the watch list. I have it sorted on what's moving today, up or down. All right, so the biggest movers down are right here on the bottom. And then as you work your way up, it's in descending order. And the ones that are making money today or have a positive move today are on the top part of that list. Now, with microchip technology, what have we got going on here? Well, it's been downward trending. You can see we used it for a trade a bit ago. But what I'm seeing right now is kind of interesting. I'm seeing what we call a descending triangle. Okay, and a descending triangle is a bearish continuation pattern. And so what do we have to have a triangle type position, or maybe not position, but pattern, maybe is a better way to say it. These squares, the white, they're not squares, this white line, that descending resistance line, and this support line here, about 51, makes up the triangle. And so what we look for is we look for it to bounce on both of these lines and kind of go back and forth and back and forth. And then once the stock breaks below that horizontal support, many technical traders like to use that as an entry to a bearish trade. So what are we seeing today? Well, that's exactly what we're seeing, right? We are seeing that this stock is really breaking below there. Yesterday was a little bit debatable. I mean, it did close a little bit below it, but not to the point that you'd say, oh yeah, it broke it. Today we're getting a stronger signal that it's breaking down. All right. Now, with something like a pattern, like a descending triangle, it helps us identify targets. And so here, I'm going to kind of scrunch this up a little bit here. And we're going to zoom in here for a little bit. On the ADX that we're just going to use as a consultant. We're not going to put any rules around ADX. Looks like the reading right now is at 19. So even though this is a bearish trend, it's not super strong bearish. It's just kind of holding its own. It's just kind of floating out there. Sometimes that might indicate if it's below 20 or 25 that maybe it's a little bit range bound and just kind of a weak trend. Okay. On this, why we're interested in this triangle is because it can give us a point to have as a target here. Now, I went back to a 10-year chart to see where do we think this thing might drop to. I had to go clear back to the 10-year to even see anything on this because it really hasn't traded this low in a long period of time. And so coming back here, the best I could do here is maybe some support around the 40-ish area, where it had the bottom of that triangle also kind of corresponded here to maybe where some old resistance was. So that makes sense that maybe it would find support as the stock is coming back down. So there could be a decent target on this. Given that there's a decent target on it, maybe we might want to do a more aggressive strategy. All right, so what I'm going to do, we see that white line down where it was 10 years ago, but I'm going to duplicate the height of our triangle, and then I'm going to take it and I'm going to activate it, and we'll take trend line 3. Oh, that's not what I wanted. Let's do Control Z. Control Z gets rid of what you just did. Let's try this again. I want to activate it, and then I'm going to grab it, and we're going to put it at the breakout area. And that gives us an idea of maybe what we could shoot for as a target on this. So 49 to 40 is a big drop, and this is going even beyond that 40, the height of that triangle. So this situation, we're going to give it a little bit more time so that it can hopefully get down to one of those targets. Would be thrilled if that would happen, right? That would be our goal. Now, as we come over to the trade tab, we're not going to use April 17th. We're going to go out and give ourselves a little bit more time. It has weeklies, but the weeklies are not that liquid yet. Okay, so we're going to come out here to the May options. We've got 49 days. Hopefully that 49 days would be enough time so that the stock could continue to drop and get towards our target. So strike prices here that I was looking at, we'll see if they still make sense here. We're looking to do a long put vertical. Look at all this open interest. Oh, good. We feel comfortable with the open interest. So price right now is about 49. We're going to do on this one. We're going to do a buy vertical because it's going to be a long debit trade. And initially it spreads it out by $1 or by 250 here in the spread. And our short leg here is 47.50. How far away is 47.50? Well, it's really not that far away. Okay. I'm going to put my mouse at about 47.50. Okay. It's kind of in that area. It's not a big for the stock. We're going to be even a little bit more aggressive here. We're going to spread it out by 5 rather than 2.5 on the spread. So here we're going to go grab the 45. There we go. And I'm going to lock this so we can work with some fixed numbers. Now, this is going to require a bigger move from the stock. But knowing that we kind of have a bigger target because of that triangle, that's why we're going to look at doing something maybe a little bit more aggressive, okay, and give it that time to do so. All right. So on a $5 white spread, our max net debit, or what we could lose on the trade, is $215. And our gain is going to be $5 minus the $215. So that should be what? That should be, we'll do it in the actual calculator here. Make sure that I don't mess up the math. 215, so minus 215 is 285. So this one says we're willing to risk 215 to gain 285. Now that's going to be over 100%. We're not necessarily going to be greedy about that, but we're going to give it the time that maybe potentially could reach that. Okay. And that kind of gets into the intermediate time frame of trades that we might do in this class, as opposed to really short time frames. Okay, we got, what do we decide there? About 49 days. All right. How much can we do? We can do 2 contracts because we don't want to risk more than $400 to $500. And if we did 3, that would put us over 600. So we're just going to go with the 2 contracts. We'll make a first trigger sequential. We'll put in an opposite order out here. And on this, we're going to take the same approach that we don't have to get every little last move on it. But if we can get a decent chunk, let's grab it. Okay, now technically, let's see what the overall theoretical return could be, because it could be what? 285 divided by 215, 132%. Are we going to be greedy and try to say, oh, we've got to get 132% out of this at all costs? We're not. we get a good chunk of it, we're going to be happy campers. We're going to move on. So in this case, what if again, oh, I should have written that number down. What was it? Actually, I'll write it down right here. It was 285 is our max theoretical gain. What again, if we get a chunk of it? What if in this case, we go for 70%? Again, not all of it, just 70%. We take our 285, multiply that by 70%. That gives us a value of basically $1.99. Let's just round it up to $2. And we'll say, okay, we want to buy it back. Good, we just got filled on our first trade there at $4.15. Okay, we're going to leave theoretically 85 cents on the table, but we're looking to get a decent chunk, right, of our max theoretical, knowing we have a big target there. So let's make it good till canceled. And we're going to go ahead and move this to trading a smaller account bucket. And I'll be able to follow up on that in some of my other classes. On the management portion, I teach option strategies on Tuesdays at, 4 Eastern. Teach the short verticals for some of our short vertical trade we put in initially. I can follow up on that in our short verticals class, which I do on Thursdays at 2 Eastern time. Okay. Now, Greg says, did you put a stop loss on for the long put vertical and the short put vertical? They were not stop losses, but they are exit points that we're comfortable getting out at if it does indeed make money for us. Okay. Now, can you put in a stop with it? Yes, you absolutely could. And you might want to have maybe some mental rules that you might want to get out on, or you can put them in. We could have done a first triggered OCO. In a hedged type position, many people don't necessarily feel like they have to have the need to put in an exit, but you certainly could. Okay, say on a credit spread, suppose it goes you twice the amount of what the credit was initially. Say it was a 30 cent spread that you brought in and it went against you by 60 cents. Then, that'd be like 100% of what we were trying to gain, but on the opposite side. Then some traders might say, okay, I think maybe I'll call it there. Okay, but some people will do it mentally and some people might physically code it in. So hopefully that helps. And Paul says, stops on options often get whipsawed, which is why some people like to use kind of a mental stop in there. But if it gets whipsawed and it goes in our favor, great, let's have our exit order sitting out there so the system can execute it for us. All right. Let's see. So yeah, we're talking about the target. Yeah, 40 would be a big target, even the bottom of that, even going below 40 for the height of the triangle. Yeah, it's a really sizable target. All right, next up. Let's take a look at Caterpillar here. On Caterpillar, I got another triangle. All right. This one, it's in the white bars. We have some support of a triangle, kind of making a little bit higher lows, but the high points were getting a little bit lower and a little bit lower. And when we would like to see it break out one direction or the other before it hits this apex. Now it's actually a little bit close to the apex here, but I still think it's a valid breakout. Okay. So we can do the same thing here where we can take the height of the triangle, use that as a potential target. Let's go ahead here and let me pin that so my toolbar stays open. And I like to take what we call the second point in the triangle to do my measuring stick. And what that means is on this, on this line right up here, the beginning part of the triangle, that's point number 1 where it touches in the bars in the triangle. Second point in the triangle is right here, this red candle that's a doji that we're kind of the bottom of. And all I'm going to do is I'm going to take that line, I'm going to draw it straight up to the opposite line, and then we'll take the height of the triangle from that point. Okay, that would be how a technician might decide to measure it and then use it. So let's duplicate our line here again. And then I'm going to drag it. We're going to put it right here at the breakout area where it's breaking out today. Let's see how far it could drop. Well, I've got an old support here about 298. Looks like it might even go based on the height of the triangle. There could be a more aggressive target even a little bit lower than that. That looks to be going down to about 333. No, that's not right. That's the top of it. 293. 293, so a little bit below that 300 target. All right. So let's set this up. Knowing there could be a decent distance to drop. Now, we don't know that any of these, we're not going to pretend to know that we know exactly what they're going to do. All we can do is look at the chart and as a technician, kind of analyze where we think it might go. Okay, so again, step number 2 is technically analyze that stock on your watch list to see if it has a valid entry. Breaking through the triangle is a valid entry. Breaking through support is a valid entry for bearish trade. All right, let's come over here to the trade tab. Now the Caterpillar, I mean, it trades on the Dow index, so it is one of the big industrial stocks, isn't it? Kind of an expensive stock. In a smaller account, some of you might be a little bit intimidated by a bigger price, a larger price stock, but you don't need to be because we can use a vertical, okay? And a vertical sure makes doing these spreads a lot more reasonable than buying an expensive, call option here that's over 2,000 per contract, right? We can't do that in our account. We're only willing to risk 500, okay? And so really using spreads makes that a lot easier. Now on here, let's see if this still makes sense. We have a big target to the downside. Currently, the stock's at 329. We could do a 330, 320, in which case we'd want the stock to trade below 320, which is about right here. All right. Is that a small move? Well, it's not a tremendous move. We could also say, well, we've got a clear target, clear down below 300 or at 300. Why don't we look for a strike that maybe takes advantage of making a bigger move? So in this case, what we're going to do, we're going to start out here a little bit out of the money on the put. And we're going to do a $10 wide spread that's going to require the stock to move more. It's going to require the stock to get down below 310. We're using May options because we want to give it that opportunity to do so. And we have plenty of open interest out here. Lots of other people trading the contracts. We shouldn't run into a liquidity issue here at all. Okay. So again, similar strategy that you might be doing. You can set it up conservatively. You can set it up aggressively. This long put vertical, again, is going to be a little bit more aggressive. Now, let's lock in 325 and let's run some numbers here. Now, this one's a $10 wide spread. Okay. Some of the weeklies do have $5 spread increments, but they just didn't have enough open interest yet. They probably will as they go along. All right. So if we take our $10 minus 325, then what we have to gain is 675. So we would be willing to risk 325 to make 375. Now that does sound a little bit greedy, doesn't it? I mean, it kind of does. You're like, man, that's almost risking $1 to make $1. It's not quite that good, but it is pretty juicy in that area. Okay. So would that meet the return for somebody doing something aggressive? Yeah, they might like that return. Not everybody's going to feel comfortable requiring the stock to move that much. But sometimes these high dollar stocks move quite a bit in a day. I mean, right now, just today, Caterpillar's down over $9.60 so far today. Now, today is a fairly big moving day for it. Okay, it's a pretty decent sized candle, but I think it just kind of points out that it's not something incredibly unrealistic. Okay, and we're going to give it the time to get there. All right, so we're going to just do one contract here because we're only willing to risk $400 to $500. So we're going to stick with that. We'll do one contract. We're going to do the same thing. When we get a chunk of it, we are going to get out of the trade. Now, how many of you would be satisfied if we only got 50% of the max theoretical gain? Only 50. Would you? Think about it. Let's run a number here. If we take 675 and we multiply that by 0.5, which would be 50%, that would be a gain of about 337. Would you be happy with that? Some of you would, some of you wouldn't. Basically, it would take 337 plus 325 to get our exit. Okay, you can answer me if you want. All right. But think through that. Would you be more comfortable doing 70%? Or are you like, that's a big chunk of a big number? Let's take our money and run if it actually goes there. Okay, so let's take our 337 plus our initial 325. All right, that's going to give us about 662 that would say, let's go buy it back for that amount. So we're going to create an opposite order. We're going to be more conservative. We're going to be very, I'm going to say non-greedy. Okay, we're not going to try to pick up a lot of breadcrumbs. We're looking to take a big chunk of the sandwich out though. Okay, so we're going to buy it at 662. We'll have Thinkorswim just go out. That order will just be sitting out there. We'll make it as a good till canceled trade. We're going to send it on, and we're going to give all of these trades a little bit of time to work. Okay, the ones that need a longer move, yeah, we do need to give it more time to actually make that move. Great, we just got filled on that. All right. Marblite, I don't know if I said that right, mentions out in the chat that you're starting to use alerts because of that whip sign possibility when options really vacillate quite a bit. Yeah, that can be something to do. Yeah, appreciate that. All right. Do your analysis on the market. Just get a watch list of stocks. You don't have to use the watch list that we used here today, although I think it can be really helpful to have something similar like this just queued up that's kind of your go-to, that you're going to look to trade something in here because you know that you put parameters on it, that it has a lot of trading activity, has a lot of volume. Typically, that leads us to lots of open interest. Now, not all of them are. Sometimes the weeklies can be a little sparse. It's kind of what I found in Caterpillar here. But this is decent activity out here, several hundred contracts. We're just doing 1 or 2 or 3. Yeah, that's plenty of open interest. You know, if you're somebody that trades, say, 20 contracts at a time, you might want to look for something maybe a little bit more liquid. But even, 500 contracts and you're trading 20 of them, you're not that big of a piece of the pie of that open interest sitting out there. All right. I do believe following a process just like what we've done today, after we figured out our market posture, what direction we want to line things up, what direction is the market going, at least today, looking for valid entry signals, doing a technical analysis. Just as you go down through your list, you might go down the first 3 and go boom, boom, boom. I've got my 3 trades that I want to do today. And you don't have to do 3 trades a day, right? But it might make it really quick and helpful for you to find what you're looking for if you have your watch list already set up. Now, in our class, we're going to go back and maybe in 3 to 4 weeks, we'll update it because new stocks could come on. And we're going to use it for both bullish and bearish directions. Now, I really hope that you've become a subscriber. I told you about that kind of at the beginning, that if you wanted to see that class that I taught how to develop and create that watch list that we did, a lot of people really liked that. Come to the playlist, come down about 7 rows. And on the 7th row, you're going to see the archives for trading a smaller account here. So the previous classes Barb's done. And then in here, you can see the classes that I've done here on the short verticals, and not yesterday, but the day before, I was thinking that was going to go to the list of them, is where we did that search, that little scan. Okay, so click on that little subscribe button down in the bottom right-hand corner. That allows you to just find our stuff easy. I love that about YouTube when you become a subscriber. And I subscribe to a lot of different YouTube channels because I do take in a lot of information. All right. Well, let's see. Ben, thank you for your help here today answering questions, what we had going on here. And, for you, practice in your paper trading account. A comment I had from yesterday said, I'm not brave enough to trade in my paper money account, but I want to encourage you to do it. That's where you test things out and you test rules. It's a great place to make mistakes. It's your sandbox. You go out there, you experiment, you learn lessons without risking money in your account. And then you can maybe develop some confidence to say, okay, I'm ready to do one trade of my live account, ready to do 2 trades of my live account, right? It can be a process. It doesn't have to be a flip the switch and you're only on your live account. Okay, so that's going to be my encouragement to you. Now, coming up next, Cameron May is going to be doing advanced charting techniques, so a little bit more technical analysis oriented. He does a great job there. I'll be back on Monday afternoon at 4 p.m. Eastern, and I will be teaching my ETF class. Now, Ben teaches some great classes that you might be interested in as well that could be companions to this class. I'm thinking in particular of an index options, where he teaches you how to use some of the indexes for some of these strategies that we're talking about. All right, everyone, we'll take a quick 15-minute break. We'll see you up at the top there, and I'll see you again next week. Thanks, everyone. Bye-bye.